Hi, everyone. Thank you for joining us today. I'm Marche, the webinar director here at Advice Chaser. Before we introduce our guest and get started, I do need to do a little bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. And Kate, if you can move to the next slide, I'd love to welcome all of you to this educational presentation once again. Attendees are muted, but we encourage you to ask questions using that chat box, and we'll go ahead and submit those questions to our presenter, and he will answer those queries during or after the webinar today as appropriate. If you ask a question in the chat box, go ahead and leave your phone number as well, just in case we don't have a chance to get to your question, and we will reach out to you after today's event to address that. Once again, we want this to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. Well, I'd love to introduce you to today's presenter. Kate Hammes is the owner of Storybook Financial in Coralville, Iowa. He is a certified financial planning professional with degrees in accounting and finance from Iowa State University. Leading up to founding Storybook Financial, Kate gained great experience working on financial plans with pre-retirees and successful business owners. He specializes also in working with young professionals. He and his wife are the parents of one daughter. And Kate, I'm going to go ahead and turn the time over to you. And I can't wait to hear what you have to say today.
Great, thank you. Today's webinar is all about how to save for retirement when you don't feel like you can do so. And so kind of the overlying theme is all about that. We're going to start a little bit with how much do we need to retire, and at the end we're going to transition more into things that you could be doing, and we'll start with kind of the easy, almost life hack ways that you could maybe save a little bit more than you feel like you are today, and we'll try to progressively get heavier hitting and bigger changes and things that you could do, not things that you have to do. Obviously, some of these won't apply to everybody because some of them are pretty big changes. So with that, I'll jump right into how much do you need to retire? My favorite way to try to calculate this out is to really try to understand what your current lifestyle is. And so by current lifestyle, I mean, how much are you spending in any given year? The way that I like to calculate it, my kind of back of the map way to do it is I take your gross income, especially if you're a W-2 person. It's a little bit easier than a business owner whose income fluctuates. But if you are a professional that has income, we take that. We can estimate your taxes pretty easy. There's online calculators if you don't know how, or you can jump onto last year's state and federal tax returns. Then you basically figure out how much you're currently saving. If you're saving a percentage of salary, we take a percentage of your salary. This does not include anything that your company is putting away for you, because that's not coming out of your cash flow. That's coming directly from them. We're only worried about your cash flow at the moment. But from there, whatever's left is your current lifestyle. A lot of people, honestly, when we calculate this number, it's very much kind of a much bigger number than they thought. They're like, whoa. I don't spend that. I watch my credit card and everything goes on my credit card. I don't spend that much in a month. What usually is getting people tripped up a little bit is they're not thinking about the annual expenses. Every Christmas we spend upwards of $1,000, $2,000, and it's a big expense, right? If you don't have your property taxes on escrow, that's once a year. It's maybe twice a year, a couple $1,000s there. But what really trips people up aren't even the annual expenses. It's those one-time expenses that just keep happening. That could be your car broke down. You had to buy $700 new set of tires. Your furnace broke down and you had to pay somebody $250 an hour to come out and fix it because like today in Iowa, it's -6 degrees. So those are the things that really kind of trip people up. And what we're getting to is your current lifestyle is very important, both now and in retirement, because it's how much you tend to spend. You can think about retirement. Some people think they'll spend a little bit less in retirement. I usually don't like to think that way. I like to think in retirement, all of a sudden you're maybe 55, 60, 65 years old, whatever it is. And all of a sudden you have all this free time on your hand. How are you going to spend it? Are you going to be spending it sitting at home, not doing anything? Or are you going to be traveling around, going and seeing some of the world? It really can increase at that point. And if it doesn't right at retirement, I promise you later in life, it will increase just because of the healthcare expenses that start to creep up. So how much do you need to retire? Well, if you calculated that on the last page, another way to think about it is how much income do I need to support that? So how much do I need coming from my accounts? The old rule of thumb is whatever you hope to spend in retirement, you need about 25 times that amount. And that's how much you need to save. What that's doing is it's saying the old 4% rule of thumb, you can spend 4% a year and never have your accounts run out of money. That was actually true back 10, 20 years ago, but nowadays it's probably not as true as it used to be. That's the reason is because bonds have come down and interest rates, they're just not paying what they used to pay. The stock market's getting pretty high in valuations. So for it to last for your full, if you retire at 60, we're hoping this lasts maybe 30 years before you need to run out of money. Or before you're allowed to run out of money. The worst possible scenario is that we get used to a lifestyle and we run out of money. And it's just not there. And all of a sudden we have a huge drop off. But that number, like I said, you could probably still make that work. There's different tips and tricks in retirement that you could be doing. And I'll get to at least one, which is, let Social Security grow as long as you possibly can, because it's a guaranteed growth each and every year of what you get to spend. Another one is if you don't hope to leave your house to your children, you might use a reverse equity mortgage so that you can start taking money out of the equity of your home. There's tips and tricks that can make that work despite not having quite as much as you would like. But chances are, if you're only saving that amount, you're not going to be having that eventful bucket list retirement. And so if you're hoping to be full on having all kinds of adventures in retirement, you might be looking at something like 40 times that income number. And so that's just kind of some food for thought as you look at your own savings and trying to understand where you are. Talking to somebody that's in their 20s and 30s, obviously you're going to have saved a whole lot less and be a lot farther off than somebody that's in their 40s and 50s. It's also really interesting because when you're saving compound interest, so you're earning interest on interest, the way those graphs work is it looks like you're not getting much from the investment. And then as you get closer and closer to retirement, it's really going to start ticking up because you finally saved enough that the interest is really starting to help. So how much should you be saving? The old rule of thumb was always kind of 15%. I would say it's somewhere between 15 and 25%, as I kind of alluded to. Some of those savings methods, investment methods have slowed down a little bit in how much we were making from those and what's expected out of your investments. So you might have to save a little bit more than you used to. When I say 15%, this is a little bit different than that number we calculated earlier, where I said don't include your employer's match. Here, we absolutely want to include your employer's match, but it should be coming back to your gross income somewhere around 15% if you're in maybe your early 30s. When did you start is very important. If you start in your 20s, that number might only be 10%. You might be able to get by with saving a little bit less. If you start saving for retirement and not until you're like 45, I promise you, you're going to be saving 25% or more to try to make up for lost time. The questions here, like how much do you have? When did you start? How much do you need? Those all go into play when you start trying to figure out that rule of thumb of what I should be saving. So the big question for today's topic is what's holding you back from savings? If you feel like you don't have enough, one of these things is probably true. The debt and the lifestyle kind of go together, right? If you have debt, chances are it could have been student loans, which is you improving your situation. I'll get more on that later, but most other debts are you trying to have a bigger lifestyle today and paying for it over time. So if you think about a mortgage, it's you buying a house that you don't have the money for today. And so you pay for it over 15, 30 years. Buying a car and using debt to pay for a car. It's you purchasing a car before you have the money saved up and you pay over 3 to 5 years for your car. And so it comes back to your lifestyle. Is your lifestyle too much? Are we just spending too much? Is there a way to reduce how much we're spending? On the flip side, and one that a lot of people don't think about is are you making enough? Is it as simple as can you find a way to generate more income rather than having to make big cuts? And so we'll jump into a little bit of these. The cost, I just wanted to point out that the cost of not having enough, if you're all about today and we're spending a lot of money, we have the big mortgage, we have a big car. Up in Iowa, everybody wants to drive the SUV still, or they're getting to electric cars and we're paying for the Teslas or whatever it is. And we're spending big money, and it's really something that we're not thinking about how much we're saving. We're worried about today, not thinking about tomorrow. So what can happen is you start spending money, say you're spending $60, $70, $80,000 a year, whatever it is, and you don't have the savings amount that you need for retirement. All of a sudden in retirement, we see this great big drop off in how much you're allowed to spend each and every year. The way you fill that gap is maybe you have to work a little bit longer. Some people, you can't work forever, and nobody wants to have to work forever either. And so trying to save as much now as possible to try to make up for that it's a much better solution. It's better to make kind of small sacrifices today. If you aren't going to have enough, it's better to make the small sacrifices today than wait until it's too late and have to make big sacrifices later. And I've seen it personally where people just didn't save enough and they get to retirement and they're determined they cannot stand their job anymore and they're retiring, and whatever happens. And so I'm watching each and every year as my retirees spend way too much money, and I'm watching their accounts go down. And every year we're looking at how much they're spending out of their account. And when it's up in the 9%, 10% withdrawal rates, I caution them, this is not going to last. Your money is going to go away. You will be living off of Social Security, which is a pretty substantial pay cut. Right now it's something like 40% of what we're used to making before. So it's just something to really think about is how can I make up the difference sooner rather than later? Because the quicker you make decisions and try to make up for lost time, the smaller and less painful the cut's going to be. So the big question, what do I do if I feel like I have nothing left to save? That's what today is all about. And so we'll start with some of the easy things, the life hacks. Probably my first and favorite out of almost everything is pay yourself first. What people mean by that, when they say pay yourself first, it means automate your savings. Whether it's you tell your employer, hey, I want it taken directly out of my paycheck. You not just for your 401k, say you have an IRA or something else that you're saving for. Sometimes your employers, you can set up a separate bank account so that they transfer money into an account that you don't look at every day. The more you can automate the savings, the more likely it is that you're going to do it. If you get it out of sight and out of mind, and get it working for you, then at the end of the month, as you're looking at your spending account and it's not there, that's money you're not going to spend. So that's kind of one of the easiest and best methods that I can preach over and over and over. The next one is pay your credit cards off in full every month. And you did read that right. That says in full. Some of you might be shaking your heads like it seems so obvious, but I'm telling you that I bet about half of the young professionals that I work with, when they come to me, they are not paying in full. They are paying the minimum balance. So what's happening? Credit cards generally charge around 20%. That's well over double what you can make in the stock market. You cannot invest your way ahead of credit card debt. If you're spending that much, I cannot begin to tell you how important it is that we get your credit cards gone. It's even if we have to find some other form of debt that's much cheaper to make them go away right away and you pay off that debt. If you can't control your credit cards, you might have to cut them up. Like it's not my preferred method because cutting up your credit cards can hurt your credit score in the long run because account history goes into that calculation. The important thing is that we just get it to where you're paying it off, paying it in full. I don't hate credit cards. Credit cards aren't evil, but you have to pay them in full. Whatever you spend that month, you have to make sure it can come out of your bank account. If you can't control it, then you're probably better off not using the credit card. You can keep it there, emergency use only, but use your debit card. Whatever you have to do, credit cards really are much too expensive to be paying anything less than in full every month. If you need to, on that, if I want to expand on that a little bit further, if you need to, because emergencies just keep popping up and we just keep reusing it, you have to find a way to save enough of an emergency fund so that you don't have to dig into the credit cards. Credit cards are not an emergency fund. I could not stress that enough. You are costing yourself far more by utilizing them that way than if you would go an alternate route and get rid of them. Another easy one. So this is really kind of a long-term play to get your savings rate up. And so if you absolutely don't feel like you can save any more right now, one trick that I use with a lot of my clients is when you get a raise, give yourself a raise. So say you get even a small, measly 2% raise that used to keep up somewhat with inflation. This year, inflation is much higher, but say you get a 2% raise. Don't just spend the entire 2%. Give yourself at least 1% of it. If you're far behind, give yourself, save an extra 2% because it's a 2% you're not used to spending. So anything that you can kind of slip in there without noticing it, you don't feel the cut, that's a great way to do it. So you get a raise, give yourself a raise, automate more savings. Another one, we talked about credit cards. And again, I try to say that credit cards aren't evil. They can be used appropriately. If you're paying it off in full and you can trust yourself to utilize them and pay them off. We all know about rewards cards. There's a couple cards out there that they might actually invest the rewards for you. So you're not just getting it in cash back or airplane miles. They might actually go into an investment account so that every little thing, every reward you're getting is getting invested. Some of them even do, what they'll do is they'll round off. Say you spend $10.50, they will round off that extra 50 cents and put that extra 50 cents. You might want to be careful with that because every time it's rounding, you might start to notice something like that, but it's a nice little way to slowly get your savings up without feeling it. And that's the whole point of these easy strategies, the life hacks. It's how do we save more without necessarily feeling their impact? Somebody that struggles with spending, you might have talked about budgeting, and we're actually going to talk about budgeting in a little bit, but I use the modern envelope method with a lot of my clients. And what I mean by that is the old envelope method of budgeting was, we had categories, we had envelopes, we had all this money, and we would put the money in envelopes and say one was for eating out. I use the eating out as the budgeting problem because that's our big problem in my household is We do the food delivery thing all the time, and we way let it get out of hand. It's definitely one of our problems that we struggle with, is we don't want to have to cook when we come home. So the envelope method would be, here is X amount of dollars. It goes in an envelope. At the end of the month, if the envelope is out of cash, then we can't eat out that day, right? So the modern envelope method is setting up an extra bank account, right? Remember, we automate the savings, so you can automate money to go into a separate account, and that account can be for your problem area. It can be for the eating out budget, and so we spend from that account only for eating out. And when it's gone that month, it's gone. We don't get to eat out anymore. Another easy thing with budgeting, and this can be as easy if you track your spending at all, if you're looking at your credit card statements, if you use something like mint.com, that's very much track your spending type of thing, where you're looking at what you spent after the fact. Look for duplicate items. I've had somebody come to me before, couldn't save enough, right? Well, I'm looking at their sheet, and they had 2 gym memberships. They had one gym close to home, a membership, and a gym close to work, and a membership. Gym memberships are not exactly cheap. You might all be laughing, but this happened with clients before, and it's just a duplicate item. It's pick one, right? You don't need 2 gym memberships. Find one, go with it. Whichever one's the easiest one that allows you to get to the gym. There's other things, but I'll keep going. Focus on getting your company matched. So when you're investing money into retirement accounts, if you're not getting your company match, you are essentially throwing money away, in my mind. Like it's free money. It's there for you to utilize. So if your company, they might match, one of my companies that I worked for, I put in 4%, they match 50% up to 4%. So I put in 4, they put in 2. But that's 2% of my salary that if I wasn't putting in 4%, I just wasn't getting. Other places offer much better company matches than that. It's not uncommon to see 100% match up to like 6%. So you put in 6%, they match that 6%. And that money really adds up. So if you think about it, I've only had to put in 6% of my salary on trying to get to 15%. They put in another 6. I'm at 12 now. So it really can make a difference over the long haul. And I view it as, if it's 100% match, that's 100% return in year one. It's really can make a huge difference. Saving on taxes with tax advantaged accounts. And so your 401ks, if you're doing a traditional 401k or a traditional IRA, what they're essentially doing is giving you a huge tax deduction today. And so when you go to prepare your tax return, especially if you do the IRAs, 401k should show up on your W-2, but an IRA, you need to let your tax preparer know that you contributed to an IRA that year, and you get a deduction. It reduces the amount of income level that you had for that year, so you don't get taxed on it. These things grow tax deferred, and then you would be taxed on it later. A Roth account is kind of the complete opposite. It's going to be taxed today, but it grows tax-free, and you get to take it out tax-free. Which is better for you? It just depends on if you are going to have higher income today or higher income later. If you're somebody that has not really saved very much, you don't plan on getting some kind of big inheritance later, chances are you're better off with the traditional method today. Save on the taxes and start investing today. And that kind of frees up some cash flow because you've saved on the taxes. Never borrow from retirement accounts. I cannot stress this enough. This is another one similar to not paying off your credit cards in full every month. It's just kind of an unwritten rule that we do not borrow from retirement accounts unless absolutely necessary. Almost anywhere else to borrow is better than this, because you're essentially borrowing and it halts any growth that you're going to get. And then you're paying the company interest, not yourself, to have the rights to be able to do so. And so it's really, really kind of a weird thing. And it can put your retirement accounts behind by a long ways. And if you don't end up paying that money back, you can end up getting taxed and penalized for not paying it back. Let Social Security grow. We kind of already talked about that one. That's just a strategy that it's Social Security the first few years you can retire before full retirement age. For most people now, it's 67 is full retirement age. You can retire a little bit sooner than that, but it's at a reduced benefit. If you can avoid that, I absolutely recommend it. It grows a little bit faster than afterwards. You can continue letting Social Security grow until age 72. So you get 5 years of extra growth if you can survive that long. And it's an extra 8% guaranteed every year. I do not know very many places where you get a guaranteed 8% rate of return. If you're somebody that just has not saved enough, that is a very solid way to try to make up for lost time. If you can spend from your retirement accounts to try to make it work. The one struggle with Social Security and letting it grow, and the only reason I would caution against it is if you hope to leave something to your children. I'm assuming that everybody here, the problem is we don't have enough saved. And so I would mostly recommend letting Social Security grow. But if you're on the flip side and you do have enough, you might not want to let Social Security grow. If you have children that you're hoping to leave money to, you can't leave your Social Security. So spending down your retirement accounts might not be the best method for you. Again, this is kind of educational. I'm trying to think of who is watching this, and anybody that is not saving enough, chances are it's really a good strategy to let your Social Security grow as long as possible. So what are some medium-sized tips? Those were kind of the easy ones, the life hacks, the things that hopefully you don't feel because they were relatively small and easy things for you to do. So what are some bigger medium-sized tips? Well, your lifestyle, like we talked about, your lifestyle, how much you spend in a year, it might be too big. So it's really going to be trying to figure out, where could I make cuts? We talked about the envelope method and trying to cut back on my eating out budget, right? That's definitely, that's an easier one, but it still can be a big change. And if it's something where you need even more money than cutting back on one account, it might be looking at multiple things, and I might start to really feel the impact of it. The next big one here is, don't just track spending. That's what I call using mint.com, anywhere that kind of pulls all of your information in and you're looking at it after you've spent it. That's called tracking your spending. That's not budgeting. Budgeting, the reason it's in mid-sized tips is because budgeting is hard. It's not really an easy thing to do. Basically to sit down every month and you're tracking your spending and you're uploading it all and you're assigning it the categories that it's supposed to be in. It can be tedious work. Honestly, it's not my thing. I don't really do that myself. And unless my clients need it, I don't really ever do it with my clients. I try to do things a little bit easier than that. But if you are really spending way too much, this might be a road you have to go down. I recommend, to make it easy, is find an app that pulls in some of this stuff for you, like tracking your spending, but it's forcing you to go move the categories. You Need a Budget is just one app that's out there that I've used and seen, and I like it. I know that's got a pretty big following. Dave Ramsey's got his own. There's multiple out there where you actually have to go budget each and every dollar and tell it where to go. And there's all kinds of training that goes with budgeting, and way too much for me to get in today on how to do it and make it easier. But it's definitely one that could help, and it absolutely could help you shrink your lifestyle and make it easier to save. The next two there are kind of on the same wavelength. Downgrade apartments, downgrade homes, downgrade cars. That's absolutely not what anybody wants to have to do, right? Nobody wants to be told they have to cut their lifestyle. But again, if you have to do it so that you can retire and keep your lifestyle in retirement, it's much better than spending too much now and having to make drastic cuts in retirement. Again, I've seen this before, where we bought too big of a house, and mortgage is too much for us to handle, and we have to basically sell the house. And it's a hard pill to swallow, to say, you know what, I let my eyes get too big. But it's really can help you in the long run. You learn to adjust to the new house, and after a while, you don't notice that you took that big step backwards. But in the long run, all of a sudden, you've been able to save all that extra money, and now you don't have to cut back in retirement. Same thing with cars. I use those two specific examples just because those are two of the bigger items that we spend money on. So those are just two general ideas. This one here is designed for anybody that's doing a student loan repayment plan. If you've developed a whole lot in student loans, most student loans, when you get on, it's a standard-based repayment plan. You're paying it off over the course of 10 years. There's so much that goes, so many different rules with student loans and things going on. I work a lot with young health professionals, and so a lot of them are working for public employers. So they're going for the public service loan forgiveness. So they have to jump onto income-based plans so that they can pay as little as possible, so that in 10 years, they hope they can get some forgiven. Not everybody has that method that they can go with. And so a lot of times the best method is essentially to pay them all off as quick as you can. If you look at student loans, they typically aren't all together. It's not one big student loan. It's like 10 different small student loans. Each is going to have its own interest rate. And so like any kind of debt repayment plan, it's looking at what balances can we make go away quickly, right? If it's a small balance, can I just pay that one, have it go away? The other way to look at it is which one has the highest interest rate. Typically, credit cards have both the highest interest rate and the smallest amount that are on them. So that's why I definitely recommend starting there. But if you get into student loans, it's trying to figure out which ones you could make go away and which ones have the biggest interest rates and trying to get them paid off. Student loans, the struggle is these are loans made to you on the promise that you can repay them later with higher income, but they're made to you without collateral. And so they have a much higher interest rate than say your mortgage is going to have, than your car is going to have. So that interest rate is what it's costing you to keep it. And so that's why it's so important that if you're not going for the loan forgiveness, that we try to get it paid off and try to get it paid off as quickly as possible. And so what I'm saying here is if you absolutely are struggling to save and if say you're not even getting your company match, and you need to save more, it might be something where you're turning on the extended repayment plans or the income-based repayment plans that will lower your payment so that you can save a little bit more elsewhere. I absolutely believe you're basically saving, right? If you're paying off your student loans, if you're making your student loans go away, especially if you're getting into the 6-7% interest, I'm as good as if you pay that off as if you're saving for retirement. The key is with any debt, if you're going to focus on debt rather than saving, it's remembering that as soon as the debt's paid off, we don't get into new debt and that we start saving at that point, because chances are you'll be behind on savings. But if your student loans are a little bit lower of interest and you just don't have enough to save, it's taking too big of a bite out of your salary, and then you're not able to save on top of pay these off, then we might look at something like the extended payment plan and try to slow those payments down. That way you can save more. It increases your cash flow. And so I wanted to point out the last ones I have here are kind of really big changes and big things that you can do. The first one is the get a side hustle, right? And so that's kind of looking at the opposite of a lot of what we've been talking about. We've been talking about how do we cut? How do we budget and decrease our expenses? How do we get rid of debt and decrease how much they're costing us? Everything's been on that side, and that's the side most people try to think about. The opposite side of that is how do we generate more income? How do we get more income to be able to save more? And so getting the side hustle. I am assuming since we have a picture of a car here, that means that somebody's thinking of driving for Uber, right? Getting a side hustle might be a short-term thing where we're working two jobs, and nobody wants to have to do this. Again, I'm trying to help people that really are behind, that really need to make up for lost time. It might be something that you have to do where you have to work that second job to try to make up for it, and hoping for a better future, right? And so an alternative method to just getting another job is trying to create your own business. What's cool about small businesses is that not only are you your own boss, I would call that more self-employed, right? When you start a small business, you're self-employed. which means you're probably working more hours for less pay, which can be a very big challenge, especially early on. But what's cool about a small business is if you can develop it to where you can afford to pay employees to help you out to where you don't have to be there every day, you've created equity inside of your business. It's basically the same as savings. Your business is worth something. You could sell your business to somebody else and they would pay you a price. If it's generating income, it's a common business that a lot of people think about is they get into rental real estate, right? That, to me, that is a business. It's not just an investment. You are the landlord. You are the person that's taking care of it. You're investing in that business and you're generating income. Hopefully it doesn't take up too much of your time. What's cool about rentals is there's a lot of companies out there that will do it for you, but they take a cut out of whatever you could be making on it. A small business is the same way, right? It's just a little bit different way of thinking about it. I'm just going to use, I like going to the coffee shop. So I'm going to use investing in a coffee shop, and I'm not endorsing investing in a coffee shop. I just want to give an example. You create a business like that, and you're hiring other people to do the work for you. Again, you've got to start out self-employed, right? Especially if we don't have enough money to do all the things we want to do already. You're starting out as an employee inside your business, but eventually you can grow it to where it becomes essentially an investment for you. Again, big change. That would be a life-altering change, and it would be a challenge, especially early on. Consider moving somewhere cheaper for cheaper cost of living. I am a virtual advisor. My daughter has cystic fibrosis, so I run my company pretty much 100% virtual, just to avoid bugs and germs that could endanger her life. And so I work with people all across the country. Living in Iowa, I can tell you that it was mind-blowing the first few times I seen the cost of living in places like California, New York, Washington. The cost of living in these places, it's just so much higher than it is here. And why is that? It's because everybody wants to live there, right? How many people want to live in Iowa at -6 degrees today? Not a whole lot of exciting things to do. Nobody wants to travel to Iowa. Nobody wants to come see the cornfields, unless you're going to the Field of Dreams. But if you move to California, it's exciting, it's warm, you've got the ocean on one side, the mountains on the other. So a lot of people want to live there. And so the cost of living goes up, right? And so if you are struggling big time to be able to save and be able to plan for your future, maybe it's considering moving somewhere. If you need to make a big change, it might be living somewhere cheaper. I've gotten written on there, moving to another country. That's not an uncommon thing. The United States is not the cheapest country to live in. There are certainly other expensive countries. I would think that most of Europe, from what I've seen being there, that they're not a whole lot cheaper than living in the United States, but there are cheaper countries to live in, and your money is going to go a lot farther. So that might be something. Again, big changes, not necessarily applicable to everybody, maybe only applicable to one or two. But these are just ideas if we need to make big changes. And the last one, and probably the most common that we see, is increase the worth of your time by going back to school. There's probably never a bad time to try to do this. A lot of people think they might be too old. I actually have a family member that went back to be a nurse in her 40s, and now is making much more money than she ever did before. And she's making up for lost time and being able to do everything that she wants to do, right? That's what school does for you, is it can get you that degree that allows you to earn more, be able to save more. It increases the side of the income, right? Costs you more today, helps you more later. And so that's kind of the last of the big changes that I have. I hope some of those were very helpful. Again, it's trying to figure out which ones make sense to you and which ones can help you out. But if there's any questions, I ended with about 20 minutes here, but I'd be happy to take any questions from anybody.
All right. Well, we do have a list of questions here, and we'll get started on them. I do want to ask attendees to go ahead and put your questions in the chat and add to the list, and we will see how many we can get to today. Just one more comment before we go to the questions. Someone put, You can look for a new job in your current career. The job market right now is really hot. So that, I thought that was a great comment someone said. Here's a question. Where would you start? Let's say you're brand new. What do you recommend that people do first? Is there a process to get that going? As far as like looking to save for retirement.
Looking to save for retirement. Oh man. Right off the bat, I work mostly with young professionals. Usually people are coming to me late 20s into their 30s, and then we're looking at this all the time. Honestly, retirement, if you're that young and you're just getting started, it might not be your biggest concern at the moment, right? If you have a load of student debt and you're paying 6-7% interest, if you have credit card debt, I almost always, if you have credit card debt, that's like number one. We want to go there, get rid of that. The next thing is if you're working for somebody and they offer a company match, absolutely go try to get at least your company match. You don't have to do more than that. You don't have to get up to the 15%. At minimum, try to get that company match. It really is, it really can help you big time. The next thing is really, if you can, it's trying to get a financial plan, whether you hire a professional or try to figure it out on your own, using some of those methods that I showed you at the beginning, trying to figure out how much you're going to need, and how on track are you. If you're just getting started, then you've got a long way to go. Hopefully my calculation helped you understand how far it is that you've got to go and how much you need to save. But definitely, even after the credit cards, the student loans, I would get your company match. Student loans would be next after the company match, just because they tend to be the higher interest rate loans. But then it's trying to save it, trying to keep out of debt, get out of debt, and trying to save and balancing those two. It really depends on the interest rates and how much it's costing you and your cash flow. Which one gets more focus. Chances are, if you're young, you might also be trying to look to save for a home, save for a down payment on a home, I should say, because most everybody I know, we're using a mortgage and we're paying over 30 years, and that's not a problem. It's just trying to make sure that it all works within your cash flow, understanding, especially if you don't have kids yet and you plan to have kids, that kids are going to take in a big piece of your lifestyle. It's going to increase your lifestyle a substantial amount between diapers and formula and daycare and setting up the baby room and all that stuff. It's a lot of expenses are coming.
Here's another question. Speaking about retirement, can you also talk a little bit about what should you prioritize first, your emergency fund or contributing to your retirement or saving?
Generally, I'm conservative, and so I like to focus on and try to get your emergency fund up, just because it's one of those things where works kind of like insurance. You want to make sure you're protected. So you want to make sure you have insurance for various things. You want to make sure that you have the emergency fund there for those emergency expenses, especially if you are notorious for putting things on the card when they come up, like I said, with the tires or the furnace broke. If you don't have money to pay for those things, absolutely, we need to get your emergency fund up so that you can afford to pay those as those happen. That being said, if you're somebody and you have, and you're going to know your situation way better than I do, if you have, say you're a very young person and you have parents that absolutely are willing to help, then the emergency fund might not be as big of an important thing for you, just because somebody's got your back. Well, that's not the case for most people. So I like to see that emergency fund get built up first.
I do have a question here about 401ks. Is there an optimal 401k contribution that can minimize your income tax?
I'm not sure that I'm following. So when I look at 401ks and trying to minimize income taxes, it's twofold of how much you're putting into your 401k. It's how much do you need for retirement, right? What is the number and amount that you need to put away so that you can retire when you want to retire? That's obviously very important. The second thing, when you're looking at taxes, that's one of those numbers that you can play around with. If you know what income tax bracket you are in, if you're somebody that, sorry, you're jumping up from like the 24% bracket into the 30% bracket, it can be a substantial jump. So if you can put a little bit more in your 401k or a little bit more in an IRA somewhere and get that tax deduction, then it keeps you out of that higher income tax bracket. Whether or not I recommend that to clients, it really depends on their entire situation. I try not to just look at taxes today, but what are their taxes throughout their lifetime? The higher up in income you are, the more you're saving, the more likely you are to have higher taxes in retirement. So it might be something totally different that I'm recommending. So it's really hard to say what's best for the person that asked, but that's how I would look at it. If you're looking to minimize taxes, it's trying to understand what bracket you're in. And if you put a little bit more into a 401k or IRA, can you get out of that bracket? Can you get down to a slightly lower bracket?
Can you talk a little bit about how you mentioned that 4% is about the amount you can safely withdraw from your retirement account when you're retired? Can you explain why?
Yeah, and so a lot of studies have been done, and that one's been around quite a long time. The 4% rule. I think when it was originally written, they wrote it as 3 to 5% rule, and so everybody just gravitated towards 4%, and then that kind of became the rule because that was the middle number. And what they're saying is when you retire, you can take whatever the account balance is. So if you have $250,000 in your account, right? You can take 4% of that and spend it each and every year. If you have a much higher amount than that, so you have $1 million, $2 million in an account, 4% of whatever the balance is. So the bigger the balance, the more you can spend, right? And the idea is that you can spend 4% each year and not have to worry about going broke if you're always looking at 4%. And what that kind of tries to account for is the account's going to fluctuate in value, right? Investments go up and down. Some years investments are going to lose money. And so you have to recalculate your 4% and what you're allowed to spend that year. But it's saying 4% is what they considered safe, that your money should last indefinitely. Well, nowadays it's maybe lowered a little bit. I've started seeing a lot of places, a lot of annuity companies and advisors, they're starting to use 3.5% as like the number that they believe now means you can spend your money indefinitely. And you should never run out of money. That's for people that don't want their account balances to come down and they want to be able to see their accounts last forever. Chances are, if you're somebody that you're not planning to leave a big nest egg to your children and you want to see, I talk about this with clients all the time. Are you somebody that wants the last check to bounce? Like when you die, you want it all to be gone. That can be a little bit tricky trying to balance what you're allowed to spend. And chances are you can spend a little bit more than that 4%. And your money should last quite a while before you end up drying everything up. Because remember, your accounts are making money too. If they're invested properly, whether they're mostly in bonds or you do have a pretty sizable stock allocation, whatever it is, they should be making money over time that offsets what you're spending. I hope that cleared it up a little bit.
KK.
Yep.
All right. For some reason, my video has frozen, but as long as the audio is still working, we'll keep going. I did have a question here about automating savings. You said that you could do it through the company. Is there other ways to do it? And then where did the savings go?
Yeah, absolutely. So if you really want to automate it, the first thing you can do is talk to your HR team and see if you're allowed to set up a second account. And so right now, chances are you're throwing everything into your primary checking account. That is probably the most common way. But you might be able to contact them and they can split X amount of dollars or X% and send it to another account for you. Not every company is going to do that. So I want to caution you that some just, it's too much of a hassle. They don't want to do it, or they can't, for some reason, don't feel like they can do it. So it's really talking to your company. The second method is almost any bank account, you should be able to go in and talk to the bank and they could automate savings to go elsewhere. A lot of banks offer like bill pay, right? And so they should also offer automate to the second your money hits that they transfer it to a different account. If they don't, then you go to that other account and you try to automate that it pulls money out of that one. So like a lot of the online savings banks, if you're putting money into those, you can go tell that bank, hey, every month, I know I get paid on the first, so every third, I want you to go pull $100 out, right? And so that account can automate it for you. It gets a little bit trickier if you want to put it directly into an investment account. Not every investment account is going to offer you that automated thing. You can certainly see, but what do you do with that money when you go to save it? If you're trying to build up your emergency fund or you're trying to do the budgeting method, then you're going to want to keep it in an account that you can have access to. If you're using this as part of your savings, then you might try to automate it directly into whether it's an IRA or a traditional retirement or traditional investment account. So we call those just brokerage accounts. Say you've already saved as much as you can in an IRA and you want to save more that's not getting saved into your 401k. You can put it into a traditional investment account where it works a lot like a bank account, but it allows you to invest in things like stocks and bonds. Hopefully that helped a little bit.
Absolutely. Excuse me. Absolutely. We have time for a couple more questions and then we have to end. I did have a question here about inheritance and what's the best way to pass on money to as far as inheritance goes. I'm going to leave that one for offline. I will make sure that we will have some information reach out, but that doesn't cover the scope of this webinar. So once again, I see your question and I'll make sure we save that and address that offline. Here's another question. Can you talk a little bit about medical debt? You talked about student loan debt. Someone here has a question. What about handling medical debt?
Yeah, so medical debt, honestly, one of the best methods for handling medical debt is to try to contact both the insurance company and if it's a hospital, contacting them directly. If you can negotiate, try to negotiate the expenses down. I typically see it can be one or two things with medical debt. It's either some error occurred, and so that's the reason it's in collections is they think you owe money and maybe you feel like you don't, and so it's trying to work it out and hopefully somebody can figure out that, hey, we don't know. I'm not making promises that that'll work, but it's certainly a method you should try. If it's legit and it's money that you actually owe, it could be as simple as talking with if the insurance company didn't cover it, then it's going to the hospital and talking to somebody there and seeing if they can put you on a payment plan or seeing if they would reduce the amount. A lot of hospitals recognize that their bills are extraordinarily high, and they're used to constantly having to battle with the insurance company and hospitals insurance, and they deal with it one way or another. And we're talking big time dollars. If you go to the hospital, it's very expensive. And the thing is we really don't ever see it because it's usually covered by insurance. So what if insurance didn't cover it for some reason? Now you get caught in the middle. They're used to dealing with insurance companies that can afford to pay, and they're used to dealing with those people. And so when they deal with consumers, they recognize that you're not an insurance company. Your ability to pay this is not nearly as great as them. So a lot of them are willing to negotiate. And so that's the first place I would go. If you need to find somebody that can help you negotiate and try to get it knocked down as much as possible. I will add one thing is if it is in collections, doing what you can to try to get it paid off. If you were ever hoping to borrow money again, credit scores only matter if you hope to borrow. So if you're hoping to take out a mortgage or borrow for a car or borrow for any reason, that's when credit scores do matter because it affects your interest rate. It affects everything going forward. And so when I see somebody's got a collection that's hurting their score, if it's a small amount, say I've seen this honestly for like $200 up to $500, and people have these collections that are just destroying their credit score. And For some reason, they just refuse to pay it. And I'm like, you're only costing yourself. You're going to cost yourself when you get your mortgage. It's going to quickly add up to well more than that money because you refuse to pay it. And so try the negotiating, try what you can, see if you can make a payment plan so that it doesn't hurt your score in the meantime, whatever you can do. But once you've kind of crossed all those I's, dotted all those T's, right, it's kind of up to you to have to pay it. And so if you need to refinance elsewhere, that might be a method. It's just kind of looking at all those options. I can't get too much more into specific details without knowing your specific details. So it's maybe just looking to find somebody that understands it and can help you out.
I have one last question here. You said you've had a lot of experience with people who have adjusted their current lifestyle in order to meet those savings and retirement goals and to get their life in order for the future. What if you noticed how they feel after they've done that, after they've made maybe those small to medium to big sacrifices? Are they noticing the difference? What have you noticed with your clients or people you've worked with?
Oh man, well, and in my situation, I'm doing a full financial plan for all of my clients, and so we're looking at, I can actually show them how much it's going to hurt later on, and how much their ability to spend is going to be, how big of a cuts they're going to have to make later. So maybe it's my way of showing them like why this is important. It's a little bit harder to tell you than to actually show you. But when they see how big of a cut they're going to have to make later, and they see the probability of success on their financial plan working out is very low, almost always when they make a sacrifice that fixes it and all of a sudden they adjust to that, it's much better going into the future. Everybody's relieved because now all of a sudden things are working out, things start getting better. They see the probability of success coming up, and it's usually a big sigh of relief. It's usually like this thing that keeps you up at night and makes so you can't sleep because you're constantly stressed and worried about it, to all of a sudden we've solved the problem, and you know that your future is taken care of. Like, it's, to me, that feels relieving when I even talk about it. So I'm hoping that you're kind of getting a sense of relief as I talk about it. Making the cuts today, I guarantee, will be easier than making the cuts later. And so that's why it's so important to get a handle on it.
Well, thank you very much. I'm going to go ahead and close things out. I do want to encourage our attendees, if something has come up, if you have a question, I will be saving the chat, and we will reach out to you if you have another question that we weren't able to get to. On behalf of Advice Chaser, we want to thank Kate for being here and the organizations that have made this webinar possible today. Thank you so much for attending. Look for an email soon with a link to the replay of this event, and you're welcome to share that with friends and family. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Once again, from Advice Chaser, thank you so much for attending, and we will see you in another webinar soon. Goodbye, everyone.
Bye. Thank you for attending.